Imagine a lone ship sailing across a vast ocean. The sun is shining, the water is tranquil. This is like the stock market in a calm state, with prices generally stable and predictable. But the market, like the sea, can change swiftly. Storms can brew, bringing volatility and uncertainty. Just as the ship's captain must navigate through choppy waters, investors must weather the stock market storms. There are times of smooth sailing, characterized by steady growth and optimism. And there are times of turbulence marked by sharp price swings and investor anxiety. Understanding this ebb and flow is crucial for any investor. Navigating the stock market requires knowledge, strategy, and a bit of courage. It's about recognizing the signs of a changing tide, adjusting your sails, and staying the course even when the waters get rough. Remember, every seasoned sailor has weathered their fair share of storms. Consider the StochRSI equation. StochRSI equals sign RSI min RSI, max RSI min RSI. StochRSI is a momentum oscillator that measures the level of RSI relative to its high-low range over a set time period, while RSI measures the speed and change of price movements. Now let's look closer at how the ship's movement mirrors stock price fluctuations. As waves rise and fall, so too do stock prices. This constant motion is driven by supply and demand, news events, economic indicators, and even investor sentiment. When demand for a stock is high, its price goes up, much like the ship rising on the crest of a wave. Conversely, when supply outweighs demand, the price drops, akin to the ship dipping into a trough. These price swings, these waves, are the lifeblood of the market, creating opportunities for both profit and loss. Understanding that these fluctuations are normal is the first step to becoming a successful investor. It's not about fearing the waves, but learning to ride them. Just as a skilled sailor uses the wind to their advantage, a savvy investor capitalizes on market movements. Picture the ship tilting precariously as a large wave pushes it off balance. This illustrates the concept of overbought and oversold conditions in the stock market. An overbought condition occurs when a stock's price has risen too far, too fast. Like the ship reaching its maximum tilt, there's a natural force pushing it back to equilibrium. This might be due to profit-taking by investors or simply a lack of further buying pressure. Conversely, an oversold condition happens when a stock's price has fallen too steeply, often driven by fear or panic selling. This is like the ship dipping too low on the opposite side. Eventually, bargain hunters or positive news can push the price back up, restoring balance. Recognizing these extreme conditions and understanding the forces that drive them is key to making informed trading decisions. Section 4. Charting the course. Technical indicators as navigation tools. Just as sailors use compasses and maps to navigate, investors use technical indicators to analyze market trends and potential turning points. Two such indicators are the Relative Strength Index, or RSI, and stochastic oscillators. The RSI, measured on a scale of 0 to 100, helps identify overbought conditions when above 70 and oversold conditions when below 30. It's like a gauge telling you how far the ship is tilting. Stochastic oscillators, also displayed on a 0 to 100 scale, compare a stock's closing price to its price range over a given period. They help identify potential trend reversals, like spotting a shift in the wind direction. These are just two of many tools available to investors. Remember, technical indicators offer valuable insights, but they shouldn't be used in isolation. Section 5. Beyond the horizon, the need for comprehensive analysis. While our ship analogy provides a helpful framework for understanding market dynamics, it's just one piece of the puzzle. Successful investing requires a holistic approach, incorporating fundamental analysis, risk management, and a long-term perspective. Fundamental analysis involves evaluating a company's financial health, its management team, its competitive landscape, and its growth prospects. It's like understanding the ship's design, its cargo, and its destination. Risk management entails diversifying your portfolio, setting stop-loss orders, and avoiding emotional decision-making. It's about preparing for unexpected storms and ensuring the ship's stability. And a long-term perspective reminds you that market fluctuations are normal. Just as a ship doesn't reach its destination overnight, building wealth takes time and patience.